Good afternoon, everyone, and thank you for joining us for our annual year-end tax and planning opportunities webinar. My name is Bob Ingram. I'm a financial planner here at Center for Financial Planning, and I'm joined by my colleague, Michael Brocavich. Michael is a partner and director of financial planning here at the Center, and on behalf of our Center team of 32 professionals, we appreciate your continued confidence and trust as we strive to improve lives through financial planning done right. Over the Center's 40-year history, we've served clients through those life's important transitions, from career changes to retirement and through family milestones. We're there with you to provide clarity and confidence when life brings new challenges and also new opportunities. And at the core of financial planning done right is recognizing that financial decisions rarely exist in isolation. They're often very much interconnected. So taxes and tax planning, just as an example, should not drive every decision, but they do influence many aspects of planning. And many planning decisions have an impact not only on your own financial independence, but on the financial well-being and success of your family for years to come as well. And our goal today is to highlight some opportunities that you have available to make the most of your resources, both now and into the future. Just one quick housekeeping note before we begin, though. While we won't be taking questions during today's session, we encourage you to jot down anything that comes to mind. Reach out to your planner or to either of us after today's session, and we'll share contact information at the end so you can easily follow up. So with that, what will we cover today? Well, let's first talk about priorities. We call it the housekeeping, things that we want to get done, and deadlines you might want to make sure to keep on your radar before the end of the year in particular. We also want to cover some important new tax legislation for 2025. The Secure Act 2.0, which of course was enacted a couple of years ago in 2022. There were several provisions that we need to be aware of for 2025 and over the next couple of years. In addition to that, there was some new tax legislation this summer with the so-called One Big Beautiful Bill Act in July that we want to talk about. And we'll cover a lot of these along the way as we talk about different strategies and planning opportunities, again, to try to take advantage of where it makes sense. And finally, we'll wrap up with some resources and next steps to take. So with that, Michael, we're thinking at the end of getting toward the end of the year here, some normal things. What do we want to keep on our radar, make sure we don't miss before our year end?
Yeah, Bob, thank you. And thank you for everyone for joining us out there. So for our clients that are retirees, I know a lot of you are familiar with the concept of required minimum distributions. So this is something that everybody needs to complete before the end of the year if you are of required minimum distribution age. Now, those of you that are sort of new to required minimum distributions, the goalpost of when you need to start that distribution has moved a little bit with some acts that have been approved over the last few years. So let's review. If you were born in 1950 or earlier, your start date for required distributions is 72. Those folks are already taking them right now, and so they're familiar that they need to continue to take those required distributions. For individuals who are born between 51 and 59, your start date is now age 73. Prior it was 72, and prior to that it was 70 and a half. So it's moved a little bit for you. And for those that are even a little bit younger, so if you were born in 1960 or later, your required distribution age is until age 75. So people really now have a lot more time before they have to begin to take these distributions, but these distributions are required. So at some point when you're putting money into these employer plans, you're putting pre-tax money in there, and kind of the deal you made with the IRS is, I haven't had to pay taxes on any of this money so far. And so now they want you to start to take some of that money out at the end of your retirement. So you need to have this done. If this is your first year that you have to take a required distribution, you need to take it by April 1st of the year following your beginning age year. So for example, if you turn 73 this year, and so this is your first RMD year, you have until April 1st of 2026 in order to take that distribution. However, after that, all distributions need to be done by December 31st of that year. So for those of you thinking, even though I'm required to take it this year, I'm going to wait till April of next year because I have that little bit of grace period. Well, just remember that you're going to have to take two next year if you delay that first one. So make sure that you're working with your planner and your and your tax professionals, and you're choosing the decision that's right for you. And you want to make sure that you understand these, because there is a penalty if you miss them. So if you do not take a full distribution, you could be assessed a penalty as much as 25% of that required distribution. Now, if you notice this, if you notice that you made a mistake and you fix it right away, that penalty could be reduced down to only about 10%. But you want to make sure that this gets done on a timely basis, so you don't have to worry about these penalties at all. And also, for folks out there that maybe have more than one retirement plan, so maybe you have some IRA, but you also have a 401k or maybe some other type of retirement plan from your employer, you want to make sure that you understand what the distribution rules are, because you might not be able to just take one distribution to satisfy all your RMDs. You might have to take a distribution from each type of account. So you're really going to want to make sure that you understand that. Now, there's some people out there that have inherited IRAs or inherited retirement accounts from a loved one. Now, if you inherited that account before the end of 2019, you probably realize that because you've had that account for quite some time now, that you're able to stretch distributions out of that account over your lifetime. So there isn't, you don't have to get it done over a certain period. It's just basically over your lifetime that you have to take those distributions. Now, new rules, any retirement plan that was inherited after 2019, that's inherited from a non-spouse, well, those distributions now have to be done over 10 years. So you don't get to stretch it over your lifetime anymore. Unfortunately, you have to distribute that account over 10 years. And if the person you inherited the account from, if they were already at the RMD age and they were already taking required distributions, well, when you're taking your distributions over that 10-year period, you have a little bit less flexibility, meaning you have to take it. In that case, you'd have to take a distribution every year. So if you inherited an account where someone wasn't already taking RMDs, you have a little bit more flexibility where you could take all the distributions. You could wait till like the 10th year or split it, you know, and in the 9th and 10th year. But if that individual was already at age RMD before you inherited it, unfortunately, you have to take a little bit each year out of that account. Now, there are some exceptions to that. For example, if you're a surviving spouse and you inherit your spouse's IRA, you can stretch over your lifetime, or you could even make that IRA your own. Minor children, disabled individuals, folks that are chronically ill, and also beneficiaries not more than 10 years younger. Those individuals are able to have an exception where they can actually still stretch it over their lifetime.
And it's an interesting example, Michael, the idea of beneficiaries not more than 10 years younger. You might think, well, how does that work? And again, siblings. I've seen a case even where maybe an ex-spouse, you know, was a beneficiary, and even though they were not spouses, interestingly enough, they were actually within the 10 years of each other, and the inheriting spouse was able to actually use the old stretch rules.
Yeah, you're right, Bob. You bring up a great point. For example, like you said, if some siblings, if you have a sibling out there where maybe they weren't married or they didn't have children, and they passed away and you inherited the account, a lot of times siblings are within 10 years. And also, yeah, like you said, I've also seen as well where maybe an ex-spouse is left as beneficiary on there. And then so they're able to stretch that over their lifetime rather than the 10-year rules. So, Bob, a lot of folks out there may not be looking at taking withdrawals out of retirement accounts, but looking to start saving and put money in. What are some things that people could look to doing before the end of this year there?
Yeah. Well, if you're contributing to a retirement plan through work, maybe 401k, 403b, and you have your contributions and you have set goals of how much you'd like to save, you know, maybe it's up to these maximums. Just to, you know, make a quick highlight, you know, 2025, you know, for a 401k, 403b, 457, for example, maximum for folks under age 50, 23,500. If you're not quite at that target yet, or maybe your own, whatever savings goal you've set for yourself for the year, you can kind of what we call super save or power save. You may have the ability, if cash flow allows for it, for the end of the year, change your contribution percentage, put as much as they'll allow. Some plans will allow you to put up as much as 100% of your paycheck. And especially if you have cash reserve savings, you could draw on the cash reserve to live on for the couple of paychecks you have left at the end of the year, and then use that to live and then have the funds go there. It'd be great to be able to say, write a check from our savings account or checking account into the plan. Obviously, we can't do that. It has to come from payroll. So that's a good way to do that. Certainly, we know for age 50 and above, there's catch-up contributions from the start of the year that you turn age 50. You can actually contribute up to as much as $31,000 toward your plan. Again, example 401k, 403b. What's interesting is that that third column over there, ages 60 to 63. We talked about the Secure Act 2.0. One of the main provisions effective this year in 2025 is that there's an extra little catch up for folks that are age 60, 61, 62, or 63 as of this year. So if you're in that age group, you have a little bit of an extra amount that you could contribute. So from the regular pre-age 50 contribution, you actually have an additional $11,250, maximum of $34,750 this year. And with that, though, you can begin to make those extra contributions the month in the year that you've turned age 60. So once you've turned age 60 this year, whatever that month is, you can contribute. A few other things, just points of note for the Secure Act. Self-employed or small business accounts such as the SEP IRA, Simple IRA can accept Roth contributions, and employer matching contributions can also accept matching going to the Roth. Employers can choose to offer that. So that may be something to understand if it's an available option. Looking into 2026, we're seeing, with inflation numbers adjusted, projected that we're going to get a little bit of a bump in the amount of contributions you can make next year. So if you're kind of getting to the end of this year, start to plan out the percentage that you want to be able to make for the entire calendar year 2026. So you're hitting the ground running in January. One additional point of note for the Secure Act 2.0 for 2026 and 2027, as you can see here, is age 50 catch-up contributions must go to a Roth IRA. This was been sort of delayed the last couple of years coming out of Secure Act 2.0 a few years back. But if what they're saying is sort of so-called high income earners. So if FICA wages from employer in the prior year exceed 145,000, you'll have to actually make those catch-up contributions to Roth dollars. So plans have been able to adjust to that. In 2026, plans can implement it. So your employer may choose that route and require it. The plan may not choose to do that. So it really depends. You just want to, of course, make sure you understand what those rules are with your plan for going into 2026 to plan for that. And then all plans as of now must have this in place by 2027. So we have a little bit of time still with this, but it's great to understand what that means. Extra contributions no longer would be pre-tax, so it would not reduce your current income. It would go to the Roth. You'd pay the taxes on those extra contributions, but they go to the Roth. Is that a good thing or a bad thing? Of course, it just depends on everybody's tax situation. For a lot of folks that may be high income earners that cannot contribute to Roth IRAs in other ways, this could be a good thing. It could be a way to contribute up to a certain point pre-tax and allow to have some extra dollars go toward the Roth. So again, big planning opportunity there in 2026 and potentially certainly in 2027. In addition to contributions for retirement plans, let's talk just a little bit about medical spending and savings accounts. So on the left-hand side, health savings accounts, and on the right, flexible spending. So real quick, we like to just highlight these where we can. A health savings account is just that, an account that you can contribute to, allow funds to build up if you have a qualifying high deductible medical plan. So you have to have high deductible. There's some qualifications, certain minimum deductible amounts, whether it's single or family coverage. Certain out-of-pocket maximums as well have to be met in order to qualify to have such a plan. But the benefit really is threefold. We like to think of it as triple tax advantage. Now, why is that? Well, one, contributions that go in are pre-tax. They're deductible. So they will lower your current taxable income. Can be a really good thing. Funds can grow tax deferred. So the funds in a health savings account, you don't have to use them in the same year. You can let those continue to grow from year to year to year. They can build up over time. It can be another type of investment, if you will. And then when you take those dollars out to use for qualifying medical expenses, you can take those dollars out tax-free. You don't have to report that income. So you've put income aside you've never paid taxes on, the contributions. You've grown the funds tax-free or tax deferred, and then you can take them out tax-free. You never have to pay taxes on those dollars in there or any of the earnings. That can be really powerful. So taking advantage of that opportunity can make a lot of sense. Once you hit age 65, you can even use some of those dollars for non-medical expenses. The key there is you don't get the tax-free withdrawals. You would actually have to pay taxes, much like you would a pre-tax IRA. But it does give some flexibility, not just in the coming years as you're contributing, but even well into retirement. Now, on the right side, flexible spending accounts, really it's designed as that, more of a spending in the year that you contribute. So the nice thing is you're able to make pre-tax contributions, lower your current income. And then when you use those dollars, you don't pay taxes on them when they come out. So it's dollars that you contribute that you never have to pay taxes on. The difference there is it's really a use it or lose it opportunity. It's designed to be used within the same calendar year for qualified medical expenses. Now, there's a little bit that can carry over into the next year, up to $660, for example, this year. But it really is not designed to carry forward from one year to the next. So if you're really looking at an opportunity to grow money that can last for several years and then you can use it in the future, flexible spending really is not designed for that, but it can be a great tool if you have predictable costs and you want to do it on a pre-tax basis, put some money in there, lower your taxes, use those funds as you may need them. Now, folks that maybe are more toward retirement or in retirement, of course, another key milestone or some deadlines to think about would be Medicare. So for open enrollment, normal open enrollments this fall, up through the first week of December 7th, you can choose to change your plan, look at the different supplemental plans, make any adjustments. Kind of looking forward into 2026, we're kind of seeing, the projected numbers for base premiums for, let's say, Medicare Part D, just about $206.50. And then, on an average, drug plan, Part D plan, somewhere around that $34 to $35 range on average, depending on which plan. From a planning perspective, we know that premiums, though, can change based on levels of overall income. The IRMA, the income-related monthly adjustment amount, is applied if you hit certain thresholds and then exceed those income thresholds. So the base premium, for example, in this chart, looking at that first line for, let's say, married filing jointly, up to $218,000 of modified adjusted gross income, you're going to pay that base premium. But then as you go into the second tier, the third tier, and so on, you pay a little bit more for your Medicare premiums based on that income level. Key things, it's a 2-year look back. So for 2026, they'll be looking at your income from 2024. So there's always a little bit of being a little behind in terms of what your real income is in the given year that you may be paying premiums. You just want to be careful if you're doing some tax strategies where you might be accelerating income. We'll talk a little bit more about that today. To not what we call step off the cliff. Unlike tax brackets where just that X dollar earned gets taxed at a higher rate, this is all or none. So if you're $1 over those thresholds, you would pay the entire higher amount of premium. Now, the good news, though, is if you've had a change in income due to some specific life events, Medicare has the ability to appeal that. It gives you the opportunity to say, well, 2 years ago, I had a higher income. I had a life-changing event such as I retired. I had a job loss, that kind of a thing, family changes, marriage, divorce, child, those kinds of specific life events are qualifying. Not every type of life event. There's very specific ones. But you can appeal and say, well, now my income is adjusted accordingly because of that life event, and it should fall under one category or another. And there's literally a form you can do to fill out for that. And we've had success in having some clients go through those life events and appeal Medicare and have their premiums adjusted accordingly. So a couple of key things just to be thinking about, a few deadlines before the end of the year, a couple housekeeping points to think of. So, we talked a little bit, Michael, about some items related to the Secure Act 2.0. There also is another new tax legislation, of course, enacted this summer. Let's talk a little bit about that.
Yes, Bob, you're right. So a lot of people out there are probably aware that back in July 4th of 2025, the One Big Beautiful Bill Act was signed into law. This act brings a lot of tax changes, some that are going to go in effect right away, some that will go in effect, over the next couple of years. There's a lot of provisions of this bill. For the sake of time, we're not going to go through all the provisions. We're going to mostly focus on provisions that we think are most important to you out there and our clients. So if you have questions on some of the other things that are part of that bill, please feel free to reach out to us. We'll be glad to help you. But the most impactful provision in that bill is extending these lower tax brackets. So back in 2017, there was the Tax Cut and Jobs Act that lowered our tax brackets. The old rates you could see here on the left-hand side, and then you can see now the current rates that we've been enjoying since January of 2018. Those were set to sunset in 2026. Those now lower tax brackets have been made permanent going forward. Also, that's been made permanent going forward are the higher standard deductions. So again, under the same 2017 Act, standard deductions were doubled for everybody and have been increasing for inflation ever since. Those also were set to sunset in 2026. Those have now been made permanent, and they actually increased a little bit under the OBBA. So as you can see here, someone that's married filing joint, their standard deduction is $31,500. So that's the beginning of your standard deduction. Talking about deductions, one of the biggest provisions in the bill is the new senior deduction. On the campaign trail, there's a lot of talk on seniors not having to pay taxes on Social Security. This provision is in there to try and help with that. So deductions of $6,000 of an additional bonus seniors will get. So you have to be 65 or older in that tax year, but you get an extra $6,000 bonus deduction. If you're married filing jointly, that means that's $12,000. Now, you do have to realize that it phases out for adjusted gross income over $150,000. It's not a cliff where as soon as you go over $1 more, you lose it. It's kind of a gradual cliff. You kind of decline by $60 of a benefit for every $1,000 you're over in income. So for example, if your income's at $200,000 and you're married filing jointly, instead of a $12,000 senior bonus, you might only get like a $6,000 senior bonus. All right. Now, it's important that everyone realize that this bonus is only available for tax years 2025, 26, 27, and 28. So, and you have to be have been 65 in one of those years in order to take advantage of it. So make sure that if you do qualify, that you're taking advantage of this because, it could be very impactful. So as we can see here, in this scenario, married seniors, both age 65, would get the $12,000 senior bonus. They'd get the standard deduction of $31,500. They'd get another senior bonus, and this is the existing senior bonus that was already in place, and that's $3,200. So their standard deduction could be as high as $46,700. And that's impactful. If you think about the top of the 12% tax bracket, it's about $96,000. So if you get a $46,000 deduction, that means that you could have almost $140,000 of adjusted gross income and still be within that 12% tax bracket. So it really gives seniors a little bit of reprieve on some taxes over the next 4 years. Now, another provision that will be impactful for people out there is this increase in how much you can deduct for SALT expenses. So what is SALT? SALT is your state and local taxes that you pay. So the property taxes you pay on your home. If you live in a city or municipality that charges local taxes, those can be deducted on your federal return. And also the state taxes that you pay. So the state taxes that you pay because you're earned income or you're taking money out of your retirement accounts and you have to pay taxes to your state, that money can also be now lumped under the SALT deduction. Now, previously, people were limited to only being able to deduct about $10,000 of all of those tax expenses. Well, the act has increased that deduction to $40,000. So that could be really impactful for people out there that live in states that have a higher state tax Also, some states or cities that have higher local and city taxes. So this could be really impactful for those individuals. Now, you have to remember that with all these provisions, one, it does have a deadline. It's not going to be around for forever. It does revert back to $10,000 in the tax year of 2030. And also, it's also important to remember that if you go over 500,000 of adjusted gross income, this benefit will start to phase out. So for example, if your income is about $100,000 over the threshold, so let's say your income was 600,000 rather than 500, you're probably only going to get the $10,000 deduction, as you will have phased out of the additional 30,000 benefit. So it's important that people understand where your income falls there.
So Michael, in terms of some planning, I mean, there's a lot of different ways to think of it. If this year people are trying to, lower their taxes, take advantage as much as possible for this, there's some different ways to kind of look at, prepaying, right? You can look at municipalities that allow you to do that, prepaying some taxes, those kinds of things.
Yeah, Bob, that's a great point. So one thing that people can do, let's say that part of your tax plan is that you have to prepay state taxes. And one of those payment periods is always in January. So maybe it makes sense for people to prepay everything in December to kind of get all that, state tax that you're prepaying in one year. Another planning strategy might be if your city or municipality allows you to maybe pay property taxes a little bit early. Maybe you're able to prepay property taxes a year, so you can kind of bunch, more of these tax expenses in one year to take full advantage of that deduction. Now, another provision that's going to be impactful for folks out there, especially those of you that are really into charitable giving. This provision doesn't start until 2026, but it does start to put a floor on how much of your charitable contribution will be deductible, assuming that you have to itemize your deductions. Okay, so for example, there is a 0.5% floor on any charitable deduction. So let's say that you had a income of $200,000. That's your adjusted gross income. 0.5% of that would be about $1,000. So let's say you gave $20,000 to the charity, well, you have a $1,000 floor of that can't be deducted. So your deduction would actually now be $19,000 rather than $20,000. So it's just important for people to realize that. So they may not get 100% of deduction of their charitable contributions starting in 2026. If you're planning a big charitable gift, you may want to talk to your financial planner and your tax professional to see if maybe accelerating it to this year in 2025, since this provision doesn't go into effect till next year, may make sense for you. Also, that's something that's going to start next year that will help individuals that are not itemizing their deductions. So if you're just taking the standard deduction, you give a little bit charitably, you can now claim charitable deductions up to $2,000 above line. So some of you might remember this from during COVID, during the CARES Act. They allowed for these above line charitable deductions. Then it was kind of 300, 600 that you're able to take. Those were a short period of time and expired. Now they've come back and they've actually made them a little bit larger. So 1,000 for single and 2,000 for married, family, and jointly. And then lastly, as we're talking about charitable giving and the concept of gifting always comes up. For those of you that are looking to gift to loved ones, so maybe your loved ones are your charity, the gift tax exemption has been increased with this bill. It was already at a pretty high rate. So gift tax exemption was at 13.9 million per person. So unless you had an estate over 13.9 million, you generally weren't worried about estate taxes. Well, that exemption has now gone up to 15 million. So increased a little bit there. And also going forward, it will now start to increase for inflation. So that will be impactful out there for individuals with higher total estates. Now, with the one big beautiful bill, it brings stuff in, it gets rid of some things. And some of the provisions that are put in there do have expiration dates and are only good for a certain period of time. And so these are some of the provisions that are only going to be in there temporarily. Some of these we didn't go over just for the sake of time, but the ones that we did, like for example, the senior bonus and the SALT deduction that we just talked about, both of those things are going to end. So the senior bonus is only through tax year 2028, and then the SALT deduction is only through the end of 2029. A couple things that we didn't talk about, but were kind of campaign promises: no tax on tips, no tax on overtime. There are provisions within the bill that helps individuals that earn tips and now overtime to save some money on taxes. You have a short limited period of time to take advantage of those. Again, it's only from now until the end of the 2028 tax year. And then lastly, for those of you that either bought an EV car this year or are working on EV home improvements, such as solar panels on your roof, EV tax credits expired after September 30th, 2025. So your car would have needed to have been purchased before then in order to qualify this year. If it was purchased after that and going forward, unfortunately, there's not going to be any more tax credits. And then also for your EV projects, you got to get that done before the end of the year, because those tax credits expire on December 31st, 2025. So you want to make sure that you get those done if that's something that you're working on. And so kind of just real quick summary, some strategies and action items for you in light of this OBBBA. You want to look at this 12% tax bracket. Like I said earlier, with this new standard deduction, it really sort of expands that 12% tax bracket for individuals. And we're going to talk a little bit more about this throughout the presentation on utilizing that 12% bracket and why it's important. But you could look at Roth conversions, realizing capital gains, and really doing some creative tax planning there. Consider accelerating tax payments, take advantage of the SALT. So work with your local municipality, work with your CPA, see what type of taxes you might be able to lump into 1 year to really take advantage of this. Be cautious of that $500,000 limit and phase out for the SALT deductions. And remember, a lot of these provisions that are in the bill have phase out periods. So folks that are making higher income, some of these provisions may not end up applying for you. So you want to understand where those phase out limits are. And then lastly, as I just stated on the last slide, make sure you're getting those energy efficiency projects done before the end of the year. You know, those are some pretty impactful tax credits that you could get, and you want to make sure that you're getting that full advantage of it before the end of the year. But so Bob, these are, you know, a lot of new rules, a lot of new tax rules always bring new planning opportunities. So, you know, what are some planning opportunities that we can maybe go over and talk to our clients out there about?
Well, I think talk about your first point above at the very top here, you know, filling the brackets, particularly lower income years, or filling up those low tax rate brackets. Now that we have a little bit of time, we have a couple of years of opportunity here. So if there could be the possibility of increasing income and accelerating income, one of the ways that could be, you know, to do that, and we always, you know, talk about, is the idea of a Roth IRA conversion. You know, just for kind of review, what does that mean? Well, funds that are in a pre-tax or traditional IRA, typically, you know, you've gotten the advantage of, you know, if it's pre-tax contributions, you lowered your taxable income. So money's, you know, 401k, 403b, pre-tax IRA that you have, you know, in that IRA 401k account. You have the potential of actually taking some or all the balance and moving it to a Roth. So unlike contributing to a Roth, which has certain income limits to be eligible, there's no real income eligibility to do a conversion. Now, you know, what's the catch? Well, the taxes. You can kind of see in the middle. You move funds from the traditional IRA, any pre-tax contributions, any earnings that are deferred that have not yet been taxed, you pay the tax on. So if you make, you know, let's say you take a $25,000 or $30,000 conversion, you put it in, you know, move it over to a Roth, the $25,000 to $30,000 would be income, presumably, for your taxes in the year that you make that conversion. You pay the taxes. Now, once you do that, it's in the Roth IRA. The benefit is it grows tax-free going forward for later. And when you're able to take those funds out, of course, you don't pay taxes on any of the growth in earnings from the point that you converted it. So why would that make sense? As a strategy for using low tax rates, or if your taxable income is lower in a given year than maybe you expect it to be in the future, that can be a great opportunity. The idea of the lower first couple of tax rates, 10%, 12%, maybe even the 22% or more, if you happen to be in an income year. We like to think of, let's say, retirees that may stop working and their income goes down a bit before they start taking Social Security. Maybe an example where pensions are there, but they don't start the pension yet. Certainly before required minimum distributions on retirement plan assets, where income could potentially be higher in the future when all those incomes turn on, and that can be a great opportunity in the early years to add a little income, accelerate some income, Roth conversion being one way of doing it. So, you anticipate a higher income in the future, it can make some sense. The other thing that's nice is for legacy. There's no required minimum distributions, of course, for Roth IRAs for yourself as the primary original owner, whereas, of course, traditional IRAs, pre-tax 401ks and such, have those required minimum distributions you talked about, Michael, every year. Roths don't have that. So you can continue to let those grow. You don't have to withdraw those. If you're leaving an inheritance, it can be particularly beneficial because, yes, Roth IRAs do have required distributions for those inheriting. So inherited Roth, non-spouse particularly, when they inherit a Roth IRA, you would have required distributions, but they're tax-free. So you would have to take some funds out, but at least you don't have to pay taxes on those withdrawals. So again, if you're going to leave some assets to family, again, a Roth IRA can be a pretty darn tax-efficient way of doing that. Everything, of course, is a balance, though. Balanced approach usually, it may sound a little boring, but typically that's the most prudent way. Having diversified places to draw money from. When we think diversification, of course, investment diversification to manage risk. Well, tax diversification, we like to really talk about, a lot with our clients, of course. And having different places you can pull money from, depending on where taxes go. When taxes are low, maybe you take a little bit of money from places that are taxable, like from pre-tax IRAs or capturing capital gains. If taxes are higher later, having places where you can pull money from that are non-taxable could be advantageous then. So having that balance of places to pull money from, can certainly be ideal.
Hey, Bob, this sounds like a great strategy, but what if folks out there that aren't retired and maybe not able to do this, what if they want to get more Roth money as they're working and they're saving for retirement? Is there ways that they could try and get more money into Roths?
Yeah, the Roth conversion can be used that way as well as another technique to save money, particularly for those that are high income earners that may not be able to, or they're not eligible to make a regular Roth IRA contribution because they're above the income limits. So by contributing, there's an idea called contributing to a non-deductible traditional IRA. What is that? You contribute to an IRA, but you're not going to be taking the pre-tax deductions. Especially if you're already covered under a retirement plan that has 401k, 403b, and so forth. Usually there's some income limits where they're fairly low that you might not even be able to do additional pre-tax contributions to a traditional IRA, but you can contribute after-tax dollars. So you could take advantage of that and then convert those after-tax dollars that you've made to the traditional IRA over to a Roth. You still have those income limits, this year, saying 7,000 for folks that are under age 50, 8,000 for those 50 and above. It's a fairly low, relatively low limit per year. And then as you convert those dollars, again, be mindful of the earnings that have been deferred in those accounts because those would be taxable. But the idea is you try to minimize the amount of earnings. So, be reasonable as far as when you're making the conversion after you've done some contributions to keep those earnings low. Now, one point of note too is if you have multiple IRA accounts, maybe you've had an old rollover IRA that has pre-tax money in that, and you're thinking, well, I'll start a new traditional after-tax IRA, convert that, I don't have to worry about the other pre-tax IRA. Well, rules are a little bit more nuanced than that. You'd have to take into account the full dollars And when calculating how much of those earnings would come out in a conversion, you have to take into account a percentage base using the other IRAs. So if you have a lot of other pre-tax IRAs, this strategy is not the most ideal most of the time because you end up having to pay a lot of taxes on the gains, or deferred earnings that are in there. But another potential opportunity is with an employer plan. Some employer plans will have separate after-tax savings buckets in addition to the normal 401k and pre-tax Roth 401k and so forth. This extra separate bucket, you could contribute after-tax dollars, and through, again, some interesting tax loopholes, you can convert those dollars to a Roth. And you may have limited earnings, and you don't have to worry about the amounts that you have maybe in individual IRAs. It's considered separate. The aggregation that I talked about doesn't apply there. So not all employer plans have this, but if you do, we like to talk to clients to encourage them to review their plan documents. Some plans change every year. Now may be a good time, especially if you're in open enrollment for next year, that this may be an available strategy for you to consider. It's certainly something to talk to your planner about and tax professionals along the way to take advantage. So we're talking about retirement accounts and investments, Michael. It's also usually a pretty good time to be thinking about, all right, my investment portfolio, we're through the end of the year, how to position things for next year. What's the kind of should be top of mind on the radar from your investments perspective?
Yeah, absolutely. So for those of you out there that are able to save not just in retirement accounts, but maybe are saving in some sort of taxable account, like a brokerage account, trust, where you have investments in there, you always want to make sure that those types of accounts, because you do have to pay capital gains taxes, you do have to pay, dividend and interest, taxes on dividends and interest. You want to make sure that those accounts are really the most tax efficient that you can possibly get them. So what we talk to individuals about is looking at what investments. First, look at what investments you have in those accounts. So if you have an investment that's producing a lot of taxable income, and maybe that's maybe interrupting or disrupting your tax planning, you could shift where that's invested. So you could take that investment and maybe have it in your IRA. So that income is tax deferred, and then have more tax efficient things within your in your taxable portfolios. So shifting investments around is always a good strategy. Another good strategy is tax loss harvesting. So how do I switch those around tax efficiently? Well, tax loss harvesting is a great tool to help people to be able to make changes to their portfolio either now or in the future. So what a tax loss harvesting is that let's say you have an investment that didn't perform very well and you have a loss on there. Well, you only realize that loss if you actually sell the investment. So what tax loss harvest would be is you would sell the investment, you'd realize the loss for tax purposes, you'd take the money and you'd reinvest it into something else so it can continue to grow. But then you're able to kind of bank that loss. And now you use that loss to offset either against other capital gains realized in the same year, or if you don't have any other capital gains within that year, you can just bank those and move them forward. So they kind of carry forward to future years on your tax return. You could use a little bit of it to offset some taxable income each year. But if you're not using it that year, it's a nice little benefit to have that could be used in future years. Another concept out there is gain harvesting. So I'm selling an investment that has a gain and realizing a capital gain for tax purposes. Now you might be thinking of why in the heck would I want to do that? Why would I want to sell something that's doing well, realize the gain on it, and have to pay taxes? Well, there could be several reasons. One, you may want to control the risk of your portfolio. So just sell that investment, and sometimes you know what? If you are paying money or if you're paying taxes on a gain, that means you made money. So you got to pay a little bit of taxes. But for purposes of helping to save money on taxes, well, one, if you're harvesting these gains and you have losses that you've also harvested previously, they can offset each other. Two, maybe it's an opportunity if you're in a lower income year. That you're realizing these gains, because individuals that realize capital gains within that 12% tax bracket, you don't have to pay a federal capital gains tax on that. And that's important. You may have some state and local taxes you pay on capital gains, but you don't have to pay federal income tax on that capital gain if you're in the 12% bracket. So if you're in a year with a lower income, or if you're able to take advantage of this new senior bonus over the next few years, where you have a higher standard deduction and now your 12% bracket's a little bit larger, maybe realize some of these capital gains. But Bob, not everybody that has a portfolio out there, they may not, be able to sell gains. They may not be able to have losses to like offset it, and they're really worried about the taxes, but they want to do something with some of these appreciated securities. What's a strategy they might want to think of if that person is particularly as charitable?
Well, there's different ways that folks can, of course, give, and we like to highlight a few of the key strategies, especially this time of year, or maybe in the holiday time, and a lot of us focus on some of our giving and donating. So, from an example of just giving cash out of pocket, writing a check to your favorite charities, and depending if you itemize and if you're able to have enough to exceed that standard deduction, you may get some tax deduction benefits for doing that. But there are also ways of actually gifting appreciated securities directly, and in some cases for folks that qualify, actually giving money directly from something like an IRA account with some differing benefits. So, looking at a couple of differences, let's talk about the idea of cash versus why would you want to give securities versus just making an out-of-pocket cash donation. So this is just really kind of an example just to illustrate some tax benefits. But let's take an example of you want to make a $50,000 that you're going to try to give, and let's say presumably to write that check, you're probably going to take it from your investment portfolio. So let's say you need to sell some things, generate that cash proceeds, write that check to your charities of choice. So in this example, $50,000. And let's say the securities that you're selling had an original purchase of $20,000. So the cost base is $20,000. You have a gain potentially of $30,000 on the 50 that you're trying to sell. So what would happen in that case is you'd have some tax ramifications for the sale, the capital gains potentially. And so looking at this, assuming high taxable or higher earners and a high tax rate, assuming 20% tax bracket, and then of course the additional Medicare surcharge of the 3.8%. It could be as much as 23.8% capital gains related tax on that 50,000. So the net, once you factor in your tax cost, the net would be giving 42,860 in this example. So that's fine. And let's say you're able to fully take advantage of the deductibility of that through itemizing, and you qualify for that. You might save anywhere from the $15,000 to $16,000. The benefit, certainly you're giving. But what about if instead, on the right side, we just donated the securities directly that have gains? Why is that a benefit? Well, a couple things. So if you were to give that same 50,000, but rather than selling it and giving proceeds, you just gifted the 50,000 of securities that have a gain. Well, one, when you gift and transfer securities that have a gain, you don't have to realize those capital gains. They go away for you, essentially. Charities that are qualified, of course, don't have to realize gains on those gifts or those donations, so they wouldn't be subject to the taxes. And then from there, you're making a full $50,000 gift without that extra tax cost potentially. So assuming you're able to get, again, deductibility at your high tax bracket, you may have more of a tax deduction because of that extra higher amount that you're able to give. So one, potentially higher deductibility that could help in terms of overall taxation. Two, you're eliminating that capital gains realization. So
yeah, this sounds like a great strategy, Bob. But what if somebody, what if they have multiple charities that they want to give to? Sending securities to each one could get a little bit complicated. Is there maybe a solution there for individuals?
Yeah, and one we've talked about, over the years, of course, we'd like to note is the idea of a donor advised fund. Think of it as sort of a smaller version, a simplified version of maybe a private family foundation that you might set up. You don't have to deal with all of the administrative headaches, setting up a board, following all those procedures. You're essentially, what you're doing is you're establishing an account with a custodian that is set up as a qualified charity. The donor advised fund at the custodian is that charity. So when you gift to the fund, you're making an irrevocable gift. You're making that donation but you're just from a tax perspective, you're making that gift to the fund. Now, once it's in the fund, it has the ability to grow. You could actually have it invested. It could build up over the years. And then even though you do not own those funds anymore, you can advise and request that grants go out of that fund to your charities of choice in the cadence that you're used to. So perfect example, Michael, you mentioned somebody may want to give a little bit every year as opposed to making one big, large donation in a particular year. And this can be a pretty effective means to do that. So a couple benefits, tax deduction that you could potentially get is in the year that you make that, let's say, that larger donation to the fund itself. Once it's there, you can make grant requests. They do have to be qualified, and there'll be a basic review process just to ensure the organizations you make requests for, are qualified charities, because it's going from a 501c3 to another. And then there are some different charities, obviously, that Michael, you alluded to as well, that over and above maybe the first out-of-pocket donation, if you're going to be able to get, let's say, in the next couple of years, $1,000 or that $2,000 extra charitable deduction, something that may be over and above that. This might be a good strategy. Obviously, that doesn't come into play till next year. So for making a large donation to take advantage of that this year in 2025, this could be a possible strategy.
Yeah. So now, Bob, with these new tax laws and some of these larger standard deductions, it may be harder for individuals to make small charitable gifts. How about some sort of strategy where individuals that are planning to give charitably over a long period of time maybe can take advantage of that all in one year?
Yeah. So that's where this kind of a donor advised fund option can make a lot of sense. So let's just look at a basic example here, and actually we can talk about how some of a few different strategies we've talked about so far today could come into play. So let's say example, Jim and Susan, they're retired and they expect to have maybe lower adjustable gross income this year than maybe they expect in future years. Let's say 100,000. Keep it simple. And so far, they've been itemizing. They've gone through itemizing, but recently they're pretty much just under where this new standard deduction is going to be. 31,500. It's pretty high hurdle. So let's say they're right under that. And when they've been normally giving their 5,000 to different charities every year, they really haven't been able to get, or they wouldn't be getting, that extra benefit of the deduction because they're just taking the standard deduction. They're not itemizing to get the extra benefit. So in this case, what if they were able to contribute? Let's use 50,000, and let's say they just cut a check to the donor advised fund. And what that does is it provides a larger single year donation. So presumably that could allow them to be up and above the standard deduction. So now that presumably that 50,000, most if not all of it would be deductible. They would get that benefit in this tax year. Of course, since it's in the donor advised fund, they could then decide, well, we're going to still make grants. Maybe we continue that same 5,000 a year we've been used to giving. We just make requests for the 5,000 to the different charities that we would like. Next year, we'll do the same thing and the same thing. 50,000 would allow for 10 years to do that. And then there's possibility for some growth and gains within the donor advised fund, depending on how they would choose to have it invested. Now, with that, potentially with some additional deductions and potentially lowering income even further in 2025, if they were to do this, what if they were also looking to say, well, can we use that as a way to then accelerate some additional income, something like a Roth IRA conversion? So what if they were to say, well, they convert some amount, maybe even up to as much as 50,000. What does that do? As we said, it shifts more money over to tax-free growth. Yes, it would add income to their total gross income. But with the extra charitable deduction, potentially, with that donation, that large donation, that could help offset some or all of that extra income. So it allows for maybe a lower tax cost of doing that Roth conversion. And then again, once with the funds being in the donor advised fund, they still have the ability to direct and request gifts in the way they'd want to do that. So can be some different applications here where different strategies of adding income and also trying to reduce overall income at the same time could work well together.
Yeah, Bob, these are some pretty impactful strategies, especially for individuals out there that are very charitable, which a lot of our clients are. But also a lot of our clients, they want to give charitably, but they might not have these appreciated securities sitting in like a brokerage account or something that they can give away, but they still want to give money charitably to the most of their advantage. Is there a strategy out there for that?
Yeah, well, as I mentioned earlier, the other opportunity can be sending funds directly from an IRA. And what does that look like? We really like to talk about and always want to bring up and keep on people's radar the idea of the qualified charitable distribution. And of course, we love acronyms in the financial world. So, acronym QCD. When you hear that, that's what this is. It's actually making a direct gift to a charity or a donation to a charity, a distribution from your IRA account. Let's say pre-tax IRA. Now, what does that do? It's a tax-free distribution because it's qualified charitable distribution. It is excluded from reportable income. So it's almost like you're getting a deduction for that distribution right off the top, before you even hit gross income. So now, who can use that? Well, you have to be 70 and a half. If you can kind of remember, well, 70 and a half, that sounds familiar. It used to coincide with the age of required minimum distributions. When the required minimum distribution age changed under the Secure Act, kind of fortunately, this did not change with it. It's still at age 70 and a half. So even folks that are not yet at the age of required distributions, you can still use this if you're at least age 70 and a half, once you've turned 70 and a half in that year. And then, of course, there's some fairly high limits. So, per person, per IRA owner, it can be up to 108,000 a year. And then under the Secure Act, this is actually increasing. So it will be indexed, with inflation. So over the years, it may still continue to go up. So it provides a fairly large amount to do. So it can be an effective tool, particularly for those that may not be itemizing. They're taking the standard deduction. They're not getting that extra benefit of making donations out of pocket or even gifting, securities to a point. Obviously, we talked about there still could be some benefits to gifting securities to get rid of the capital gains. But if you're not getting the extra deduction, this can be really effective because, again, it could reduce income. If you're also in RMD age and you have to take RMDs, well, rather than just taking distributions, part of your normal retirement income, and then making charitable gifts, have it go directly from the IRA. That way, it counts toward your required distribution. At the same time, you don't have to claim the taxable income. So it can really be a double benefit there if you're already in RMD status. We really talk a lot with clients that are approaching this age and they're over 70 and a half of how to effectively use your IRA assets to manage your overall, income as part of your retirement paycheck planning. So I know we've talked about a lot. We've covered a lot so far, Michael, a lot of new changes, a lot of things with new tax legislation. What are some things we want to make sure everybody takes away today?
Yeah, absolutely. We have gone over a lot for you guys today, but some key takeaways that we want to make sure that you're understanding is make sure you address those priority items before the deadline at the end of the year. So if you need to take RMDs, if you still haven't done open enrollment, either for your employer or Medicare, making sure that you're getting that stuff taken care of before the end of the year. Take advantage of your retirement plans. If you haven't maxed those out, maybe now at the end of the year is an opportunity to increase your contributions. If you're getting a bonus at the end of the year, maybe you can increase your contributions to try and max out your 401ks or whatever your employer retirement plan is. The One Big Beautiful Bill Act, it presents a lot of planning opportunities. There's a lot of provisions in it. And there are some what we call pitfalls, but really it's just, a lot of these provisions phase out because of income. So you want to make sure that you understand that and you're maximizing these deductions for the short period of time that they're around. You could have reasons to accelerate income before the year ends or reasons to lower your income in 2025 just due to these new provisions or existing provisions. So make sure you're getting with your planner and your CPA and understanding those things. Great time to review your investment allocation. As we talked about earlier, make sure you have the appropriate positioning of your investments to match your goals, your risk tolerance. Make sure that it's positioned so it's more tax efficient. and some of the other considerations that we discussed today. Then lastly, consider your charitable gifting goals and donation strategy. As we went through, there's a lot of strategies. There's some new rules. There's some stuff going away, some stuff being added. There's income cliffs that are there that exist. So you really want to understand these. There's still a lot of great strategies for people to give money charitably if that's your goal. You just want to understand what those are and how those are going to impact your taxes going forward. So Bob and I, we just want to thank you all for joining us today. What our next steps are. If you have any questions, please reach out to us. So whether you're reaching out to your planner, individual planner here at the center, or if you want to reach out to Bob or myself, please do so. Here's our email addresses are here. There's also a QR code that'll take you directly to our website to allow you to look at the profiles of our planners or be able to contact us directly. For those of you out there that are brand new to the center and maybe this is your first experience and you want to know if some of these tax strategies apply to you, give us a call or shoot us an email. We're glad to give you a complimentary 30, 60-minute consultation just to go over your situation. And then also, sign up for stuff that we have coming up down the road. So we have a tax and planning guide and monthly newsletter that goes out to clients. If you'd like to sign up and be a recipient of that, please use this QR code here on the right to do so. We have blogs that our planners write very often. We also, if those of you out there that you haven't heard, our planners here at the center wrote a book together. It's called Finding Your Center. So if you'd like a free copy of that, please just let us know. And then lastly, stay tuned for things that we have coming down the road. So we're constantly having these educational type of webinars on all different types of financial planning topics. We also have in-person events. So make sure that you're looking at our calendar, and if there are some things that you're interested in, that you're able to sign up for those. So again, thank you all for being with us today. We know that it's a lot of information, but it's a lot of important information. So if any of you have any questions, please don't hesitate to reach out to us. And thank you, and have a great rest of your year.